Welcome to the cash flow board. I'm going to start to do these types of whiteboard lessons, more in details, less editing, just to make sure I get as much as value to you guys about private money lending. So this is my blueprint I'm going to cover today for how to do solid private money loans that generate double-digit returns. So I'm going to cover the framework that I use with more details. Hopefully you can read it. And if not, I'm going to read it to you. So let's get started by the big three pillars that I use for my private money lending is position, protect, and cash flow. And the first thing is position. That's what I'm going to talk about here. And everything starts, I believe, with setting your lending box. Your lending box is the North Star. This is the framework of what you are going to lend on, as far as what the type of experience level you're going to require from your borrower, what type of market, which state you're going to lend in, because every state has different foreclosure laws, and we want to be in states that have easy foreclosure laws, that it's cheap, they don't require licensing, there is no redemption period, and generally it's easy, lender-friendly states. And I currently have 10 states: North Carolina, Tennessee, Mississippi, Alabama, Virginia, Texas, Missouri, Arkansas, just again, Oklahoma, just to name a few. In the lending box, you need to define again the state, the area within the state. You obviously don't want to be in rural areas when there is no investors' activities or any activities at all. So I always look at the days on the market. I want to see activities. I want to see solid comps. I want to also understand the exit strategy of the borrower, because the exit strategy will be based on the time frame that you are willing to lend. I like short-term loans, 6 months or so. So that will dictate the lending, the exit strategy. That's why I only work with people who do minor flips or DRR when I fund the first step before they going to refi me within 6 months. I also like to do wholesaling. Again, most of my network are wholesalers, because I used to be a wholesaler and a flipper. So when wholesaler get a great deal under contract, they want to close on it and put it back on the market and sell it to a retail buyer. I will be willing to fund these types of deals because they're usually at a deep discount, great properties, and this is another exit strategy that I like. And also the amount, you need to feel comfortable of how much you are willing to lend per deal. For me, it's up to $200,000. I don't go over that. And this is pretty much, you need to define that, because that will dictate the type of leads that you're going to attract, because this is the next step after setting your lending box, is the attract. And before we move forward, hopefully, if I haven't introduced myself, my name is Chaim Oman Palman. I've been in real estate investing for over a decade, doing flips, wholesaling, buying rentals, and I've been a private money lender for over 7 years now. I've done over 300 loans, did the bad, the good, and the ugly. And now I just want to share with other real estate investors that tired from all the operational overload of flipping, just to show them a better way at the seat at the table with being a lender. That's what I'm going to talk about. After you set your lending box, you're going to start to attract people to your world and present to you potential deals to fund. So first of all, the way I do it, again, I'm not saying that's the only way, it's by content in social media, Facebook, Reels on Instagram. And what recently works great for me, it's Facebook groups. When you're gonna punch private money lenders in specific, there's like nationwide, and there's maybe in specific states or areas, and people always look for money there. So just see who needs funding for your deals. Just comment that you are a private money lender, you have to work with experienced investor, and some people will start reaching out to you. And once you do that, this is when you start to filter them, because you can ask 3 to 5 questions, like kind of what market you're working. If it's your market that you're working, great, you continue the conversation. If they tell you, again, I'm in New Jersey, you can kill the conversation and says, sorry, I don't fund deals in New Jersey at all. Then you can ask about what your level of experience, what's your exit strategy. And if you see that there is a fit, you can go to a Zoom call. I usually like, before we go to a Zoom call, I like to tell them what's my rates, because I don't want to waste all of this time chatting with them, going on a Zoom call, then dropping the rates and tell me, listen, it's too high for me, or they don't understand the value that I bring to the table. So I want to make sure that they understand that I'm not the cheapest guy. I will highlight the benefits of working with me. I'm fast, certain. There's certainty with me. When I say yes, I'm going to fund the deal, and it's convenience. There's not a lot of paperwork. There's not a lot of hoops that they need to jump. So that's what I provide as a private money lender: speed, convenience, and certainty. Okay, so if they like what they hear, we're going to continue to the next step. I'm going to invite them to a Zoom call. And in the Zoom call, I'm like, it's going to be a vibe check. I'm going to ask them about their experience level, about the type of business that they do, about their operation, about the team that they have, how they fund the deals. Going to speak with them about their typical deals, what they're looking for to work with a private money lender. I'm going to share with them my process of how I work as a private money lender. Usually during the call, I'm going to ask them, can you show me your typical deals? And I want to see if they are organized, if they have folders or before and after with the documents. That will give me an idea if they are serious investors, if they are experienced. Maybe they will pull some HUD statements. So I want to make sure that I see that during the Zoom call. And if it's a fit, again, I can ask them which type of LLC that they use, so I can do a little research. I can ask from them their articles of organization or certificate of good standing, to make sure that the LLC is legit. And if there is a fit here, I'm going to, again, at the end of the call, I'm going to tell them, listen, I think you're exactly the type of investor that I would like to work with. Hopefully they will think the same thing about me. And if it's a yes, I'm going to ask them if you have something that meets my criteria. At this point, obviously, I'm going to share with them my lending box in detail. And if it fits my criteria, they can send me deals for me to review. So this is usually how the first piece works: lending box, content, getting leads, filtering them, pushing it to a Zoom call. If it's a fit, I'm going to ask them to start sending me potential deals to fund. This is the process so far. And at this point, we're going to move to the protect phase. Remember, there is position, protect, and cash flow. So during the protect phase, first of all, I'm going to analyze the deal. I want to make sure that they send me an address. I need to know what's the purchase price, what's the after repair value supported by comps. So I'm going to check comps, active, pending, and sold from the last 90 days. I want to make sure I get scope of work with budget, with itemized scope of work. I want to get a link to pictures and video. And also I want to make sure that they give me the ARV that they think, because I'm going to check it to make sure there is a match. Okay, so I'm going to add here ARV. And if everything checks out, because I need to know how much they purchased the price, what's the repairs estimate, what's the after repair value, for me to understand what's the terms of the loan is going to be, because I want to make sure when I give them the term sheets, I verify these numbers. So I'm going to tell them, listen, it's going to be, usually I want to be 65 loan to value or lower. I want to make sure it's 85 to 90% loan to cost, meaning that they will need to bring 10 to 15% of down payment out of pocket, skin in the game. Usually my terms are 3 points, 12 to 14% interest for 6 months. And I'm also going to tell them the extension fee from the get-go, so they know if they don't meet the 6-month period. And usually there's no issues, because we wouldn't be on this call if they can't get out of the deal in 6 months. They understand there's an extension fee, because if the project is delayed, if there's any issues with the refi or with the sales, it's not going to affect me, because I'm a lender and I'm getting contractual income, not operational income. So there will be an extension fee, and they understand how much is it. It's usually 2 to 3 points, depending if they want to go a 3 months extension or 6 month extension. Okay, so once I present it to them, they can either tell me great, or we want to move forward, or no, it's not going to fit for me. But usually at this point, 99% of the time, we are going to move forward to the next step of the process. They need funding for the deal, they need to close, and I'm going to tell them after the analyze phase to the risk filters. Basically, they're going to do an introduction email to their title company. They're going to introduce me as the lender of this transaction. I'm going to send them an email with my requirements. The two big things that I need is from the title company is the CPL, the coverage protection letter, and a title commitment, the Alta title commitment, which basically showing there is no title issues with the property, and they will be able to insure it. There is no liens or anything like that. And if that's the case, that will allow me to go to the next step, which is preparing the docs. Before preparing the docs, I'm going to ask the borrowers to get me an insurance, evidence of insurance, or certificate of insurance when it's showing my lending entity as loss pay, meaning that if something goes wrong with the property, I will be sent the amount of money. I will be like on the insurance policy. I will have a beneficiary interest in that. And I want to make sure, obviously, that the coverage is more than my loan amount. And definitely, at least the replacement cost to make sure they are protected with $1 million liability and all of this good stuff. And then I'm going to prepare the lending docs. Obviously, if it's the first time that I'm working in this specific state, I'm going to hire an attorney to draft the documents for me to make sure they're preparing the promissory note, the deed of trust, or the mortgage. In most cases, the states that I'm going to work in are deed of trust states, personal guarantee, assignment of rent, if this is a BRR deal. But generally speaking, like 99% of the time, I'm going to get them an assignment of rent and leases, meaning that if the deals go sideways, there will be a liens recorded, meaning that I can collect the income coming from this property while I'm processing the foreclosure. Once I have all of these documents prepared, either by me or by my attorney or by my title company, I'm going to send them to the title company that will prepare the full closing packet to the borrower to sign and notarize. Okay, obviously at this point, I'm going to review the HUD. So there will be HUD review. I want to make sure my points are collected at closing because I'm getting paid at closing the 3 points. That's what I like about lending. You get paid first. And also, usually I get the prorated interest of the month of the closing. So I want to make sure I see the prorated interest also charged on the HUD. And if that checks up, they're going to prepare the docs. The board is going to sign and notarize it. We'll send it back, the original, to the title company. And then the title company will need to let me know if we have the green light to close. And if that's the case, obviously we're going to move to this part, the cash flow. Before I go to the cash flow, if you want to learn more about private money lending, there is a school community that I have. You're going to see it in the description below, so feel free to join. And if you want to work with me one-on-one and be part of my coaching program, when I'm walking you through how to close your first private money loans in 45 to 60 days, that's the goal. Reach out to me, send me a message, and we can get on the call to see if I can help you fund your first private money loan and generate double-digit return. This is what I do. Next step is the cash flow phase. Okay, the cash flow, at this point, we're going to fund the deal always to the title company after we verify the wiring instructions to make sure the money goes to the right place. As I mentioned, I'm going to collect the points at closing, meaning we get paid first. So cash in at closing. I'm also going to set up part of the documents is there will be an auto payment deduction or auto payment confirmation from the borrower that every month on the first, the money is going to go out of their account to my account. So I don't need to remind them anything like that. And usually within 6 months time frame, more or less, there will be a payoff. The title company of the buyer or of the borrower is going to reach out to me and they will ask me to prepare a payoff statement. I'm going to get a payoff statement, and once I get the payoff statement notice, it's usually a time for me to prepare for the next loan. I want to make sure that my money doesn't sit idle. So once I know the closing date, more or less, I'm starting to reach out to other potential borrowers. Sometimes it's going to be the same borrower that we're going to roll the funds to another deal because 95% of my borrowers are repeat borrowers. We keep going from deal to deal, so the money rolls from one deal to another. So we will be able to redeploy the funds to make sure that I can collect the points again because I collect 3 points, 13% on average, and every 6 months, meaning that I'm going to get 6% plus 13, meaning that 18 to 19% ROI. And I haven't even spoken about my co-lending model when this ROI bumps to closer to 30%. Plus, when I bring a co-lender with me and they fund a portion of the loan and I fund a smaller portion of the loan, that's bumped my ROI significantly. So this is the model: position, protect, cash flow. This is the workflow of what I teach in my coaching program. So if this is something that you think will benefit you, reach out to me and I would love to work with you. Peace.